Hello and welcome back to our channel. Today, we're going to be talking about how to conduct a financial analysis. Understanding the financial health of a business is crucial for investors, business owners, and anyone interested in financial planning. In this video, we'll cover the basics of financial analysis, including the different types of financial statements, financial ratios, and how to interpret them. Let's start by discussing the different types of financial statements. There are three main financial statements that every company produces: the income statement, the balance sheet, and the cash flow statement. For example, let's look at Apple Incorporated's 2020 financial statements. Their income statement shows that they had revenues of $274.5 billion and net income of $57.4 billion for the year. Their balance sheet shows that they had total assets of $323.9 billion, total liabilities of $258.5 billion, and total equity of $65.4 billion. Their cash flow statement shows that they had net cash provided by operating activities of $81.4 billion, net cash used in investing activities of $73.6 billion, and net cash used in financing activities of $67.4 billion. Now that we've gone over the different types of financial statements, let's talk about financial ratios. Financial ratios are used to analyze a company's financial performance and health. They're calculated using the financial statements we just discussed. For example, let's look at Apple Incorporated's 2020 financial ratios. Their gross profit margin was 38.2%, net profit margin was 20.9%, current ratio was 1.4, and debt-to-equity ratio was 1.51. Now that we've gone over the different types of financial statements and ratios, let's talk about how to interpret them. When analyzing financial statements and ratios, it's important to look for trends and changes over time. You should also compare a company's ratios to those of its competitors and industry averages. For example, let's say we're analyzing the financial statements and ratios of two tech companies, Apple Incorporated and Microsoft Corporation. We notice that Microsoft's net profit margin has been increasing over the past few years, while Apple's has been decreasing. This could be a sign that Microsoft is performing better than Apple. We can also compare their financial ratios to industry averages. For example, the average debt-to-equity ratio for the technology industry is 1.53. If Microsoft has a debt-to-equity ratio of 1.0, this could be a sign that they have less debt than their competitors. When interpreting financial statements and ratios, it's important to take a holistic approach and consider all the information available. That's all for today's video. I hope you found this overview of financial analysis helpful. If you have any questions or comments, please leave them in the comments section below. Don't forget to like and subscribe to our channel for more helpful content.